Okay, so next is going to be a live interview with Gene Trowbridge. So I'm looking forward to this, have been looking forward to this for a long time. Gene, an expert in the industry. I'll read his bio and then we'll have some fun. So Gene Trowbridge is founding partner of Trowbridge Nieh. His practice concentrates on the syndication of commercial real estate through both debt and equity. Between Gene's individual syndication background and the firm's legal practice, the partners and the firm have written offerings of more than $5 billion in monies raised. Join me in welcoming Gene to the stage.
Thank you, Adam. I was just mentioning to my friend over here that I didn't necessarily appreciate him talking about grizzled baby boomers who were grizzled veterans, but be that as it may, I've been in the business a long time, and as you said in the introduction, I was a syndicator. I was a syndicator for 20 years and built self-storage facilities in Orange, Riverside, and San Bernardino County. And then when I was the ripe old age of 45, I decided I'd go to law school. And I've been doing that for, 30 years. So if you can add, you can see how grizzled I am, right?
Great.
Oh, man.
Got him. Good job over there. Got him. Got him back. So Gene, I do want to start and kind of stay on that vein of maybe some of your background a little bit more. So I know you were teaching, 40 years. I think one of your students you met and you meet them all the time when you're going around. So maybe before we get into some of the meat of the conversation, let's start there.
I've outlived many of my students, that's for sure. I don't know if anyone knows of the CCIM Institute and CCIM Education. I was there very early on and was a senior instructor for over 40 years and did that. And then 3 years ago, I retired from that part. And that's where I know James from. James, who isn't here today, was one of my students when we...
Jim was one of your students?
Sure,
I didn't know that.
on his way to get his designation. That's for darn sure. So that's good. I learned a lot about real estate. I heard the conversation. I thought it was a good panel discussion. I don't know what surf means, but maybe if I've been born in California, I would, but I'm from Minnesota, so I know what walleye and muskie and all that stuff is, but not surf. But I thought it was very interesting. I think one of the things that I didn't hear is that, because we're all talking maybe just about real estate, but one of the things I didn't hear is and I heard about this on a Marcus and Millichap video the other day, the obsession with negative leverage. And the street definition of positive, negative, and neutral leverage is when the cap rate, the first year cap rate, is related to the interest rate on the loan. And so if you're borrowing at 7 and buying a property at a 5 cap rate, you're negative leverage. And actually the rule is when you're in negative leverage, borrow as little as possible, and the banks are helping you out with that these days because they're not giving you very much. If you're buying at 7 and if you're buying at 5 and you're borrowing at 5, you're neutral leverage. We just came through a great couple of years where we were borrowing at rates that were less than the cap rate, so positive leverage. And that positive leverage means an increase in overall yield during the holding period. So we're now in a period really of negative leverage, and I'm old enough to know people who have said for 20 years, I'm not buying until cap rates come back to 10. Okay? Well, okay, so don't buy. I don't know what you're doing, cryptocurrency. I don't know what they're working on. So that's an interesting discussion, and I will tell you from a technical standpoint, comparing the first year cap rate and the interest rate simply isn't a great discussion of or definition of positive, negative, or neutral leverage, because the second year NOI might go down. the value of the property might go up. So really, it's an overall yield compared to the overall rate of the loan, which isn't just the stated rate. It's the rate plus points and prepayment penalties and all that. There's a lot to it, but we are in a period of a negative leverage. And one other thing before we get on to our discussion, one of the things that I see is that we came through a period of time when there was an overabundance of capital and people were just dying to buy properties. And sellers were saying, well, hell, if you're going to give me that much for my property, I will sell. Right, Jenny? and we're now in a position where that's gone away. And sellers aren't getting buyers pounding their doorsteps. So I think what has to happen for a seller today is we have to have some lifetime event that's going to make it interesting to a property owner to discuss selling. For us syndicators, sometimes we tell people that the holding period is 5 to 7 years, and I know from my experience that on the 5th year they're at the door looking for their money. So sometimes you have to sell a little quicker than you might have thought about. People's lives change, and until there's some sort of a life event that wants them or tells them that they need to liquidate and get out of the piece of real estate. Management is too much. The oldest daughter wants a big wedding. Who knows why you have to sell, but there are not enough of those lifetime events going on now for people to want to free up their real estate, and there's no one screaming to buy it. But I will tell you, this is a normal market. This is normal. The last couple of years were accelerated and weird beyond belief. But this is a normal market. I have been through the 86 Tax Act in 94 and 78. I've been through all of these markets. And there aren't too many of you in the room who look like this, but I had a 13% mortgage on my house at one time. So when you were buying houses the way I did this last time with the 2 3/4% mortgage, that's unusual. We are in a normal marketplace, and it's going to take a while for people to deal with that. There's all sorts of times that I've been in the business for 50 years that if you could borrow at 6 or 7%, you would have been thrilled. There's no doubt about it. So we just have to go along. And one of the questions that I know you're going to ask me is, what are my clients doing today? We have written over 1,000 offerings with 850 clients, and my top 4 clients in 2003 ain't doing any deals. They're spending all their time on capital calls to deal with the interest rate caps, because interest rates went up like crazy. You take out a 5-year bridge loan at 3.5, and all of a sudden you're ready to refinance it and rates are 7. You're just in real trouble. So they can't raise any new money from clients until they get their troubled properties taken care of. And most of the troubled properties in my world were purchased in late 2001 and 2002. Okay, so that was a lot of bull, but that's the way I feel about it. So let's talk about, I'm going to ask you a question.
Oh, this is good. I'm in.
What does the word syndication mean?
So that was my question for you.
I know.
He took all my questions. Come on, Gene. No, but seriously, for our YouTube audience.
Yeah.
So I know in this particular room there's a lot of sophisticated real estate investments, a lot of investors and people in the business. But for our YouTube audience at home that maybe are just getting started in real estate, or maybe you've kind of thought about it, but you're like, is now the right time? Is it not? First off, you mentioned you're a syndication lawyer. Or I mentioned it in the intro. What does that mean?
That's the number one question I get on the phone, and I answer all my own phone calls. Gene, I want to put 5 or 6 people together, and we want to buy a property. and I don't want it to be a syndication.
Really?
Wrong question. 2 or more people joining together to do some business is a syndication. That's just what it is. I mean, we all syndicate. Mark, you flew in from Florida? Do you own a plane?
No.
Are you a pilot?
No.
So you and 147 of your closest friends syndicated a way to get here, right?
It was about 250.
About 250. The only thing you didn't have that the people who are calling me are asking me about is you didn't have a profit motive. In buying your ticket, there was no profit motive. You needed, it was a utility. You needed to get somewhere. GoFundMe pages. Those are syndications, right? But there's no profit motive. Now, so I say to Adam when he calls me, well, that's not the best question of all. The real question is, now that you're doing a syndication, have you stepped into the securities world? And they say, well, I don't want to do that. Well, that's normal. But you're going to have to do that if, in fact, there's a profit motive and if, in fact, you're going to be in charge of this. So we kind of have to talk about why does a syndication with multiple investors take you into the securities world? Should we?
Do it.
Okay. As simple as I can do it for the YouTube. We have a YouTube channel, and I have...
What's that?
It's
What's
called
that?
Trowbridge Law, and I have a YouTube on this. The simplest definition of a security is where people invest their money in a common enterprise with an expectation of profit through the results of someone else. And what differentiates a GoFundMe issue from a securities issue? In GoFundMe, there's no expectation of profit. But you're going to buy a multifamily, you're going to build a self-storage, you're going to do retail. There is an expectation of profit. And one of the great misnomers is, and I'm talking to someone in the audience, there's no exception from the securities rules for a deal that's just friends and family. That's not relative. What's relative is you're going to raise the money, you're going to make the decisions, everyone else is passive. Welcome to the world of securities. And my book that I have out there is called It's a Whole New Business, because that's a brand new business to people going in the securities world. So that's why I'm a syndication lawyer, coming from a syndicator, working in the securities world. When I went to law school, I said, that's exactly what I'm going to do.
So syndication sponsor, maybe let's have you talk a little bit about that, and then maybe some of the questions that investors, as they're thinking about the right questions they should ask sponsors. So maybe just start with what a syndication sponsor is to get us started.
A syndication sponsor is the fellow up here doing the mini storage. He was a syndication sponsor. Ryan. He was a syndication sponsor. He raises money from people. He puts all the money in his enterprise, which is to build a storage facility. The only reason they're investing with him is so they can make a profit. And he's going to make all the decisions. That's what a syndication sponsor is. I think that's more important to pick the right sponsor than it is the right property. If I was going to be an investor, a passive investor in someone else's deal, I'd have 4 questions to ask. And if I'm going to be a sponsor, I think you should know how to answer these questions. So it's good for everyone who's listening, Adam. The first question is, Adam, if I give you all my money, if I give you $50,000 to invest in this deal, what happens if something happens to you? That should be a conversation stopper. That should be an investment stopper if Adam doesn't have an answer that deals with continuity. In our firm, we wouldn't take on an offering responsibility, drafting all the papers, if Adam came to us and he said, well, it's just going to be me, Gene. Not fair to the investors. Not fair to the lenders. All sorts of reasons that doesn't work. So the number one question you should ask is, what's the continuity plan of the sponsor? Okay. The number two question I think you should ask is, Adam, have you done this before? That doesn't mean I won't invest with you if your answer is no. I haven't done it before. When I started, I hadn't done it before, and I had to get people to invest with me, so I must have had some other expertise, credibility that got my first deal done. So when I ask Adam the question, have you done this before? We've got to get him to the point of saying, hell yes, once. We've got to get that first one done so that we know that you can do everything there is. You can find the property, you can raise the money, you can get it started, and you can manage the property. We need to know that. I think that's important. The third question is, Adam, are you going to put any of your own money in? And the typical question is, do you have skin in the game? Okay. And I used to think that the only thing that counted was how much money he put in. If everyone else is putting $50,000 in, does he need to put 50? There's nothing legal about that. That's kind of a marketing question between, I have clients whose minimum investments is $250,000 or $500,000, and they don't invest that much in their deal. But one of the things that I've decided is most important in this world is, are you signing on the mortgage? In any way, there's always some personal liability. Even if it's just carve-outs, there's always some personal liability. So your skin in the game that you're going to tell me about is, yes, I'm putting in some money, whatever it is, and I'm going to be signing on the loan. And now we're talking marketing perception more than anything legal. Is that good enough for me? And then the last question I'm going to ask Adam is, well, Adam, I'm a little gray. What's your liquidity provision for someone like me? If something happens, how do I get out of this deal? And what you have to say is, you have to say, well, our operating agreement, drafted by professional attorneys, has a couple sections in there on liquidity. And I'll go over it with you. And you have to be able to solve my issue of liquidity before I invest with you. So I think those are good questions for every investor to ask. And we've already given you an idea, if you're going to be a syndicator, how you need to answer those questions so that your marketing is good. And I never used cap rate. I never used NOI. You don't even know what type of property I'm talking about. One of the deals we did last month is we helped someone buy a hockey team, a minor league hockey team in the Dallas area. Okay, so we don't need to worry about cap rates and all that. And we do a lot of startup businesses. Every startup business runs short of money somewhere along the line and needs to raise money from investors. So it isn't always real estate, but most of our practice is.
Let's stay on that same theme. What are you seeing right now with deal flow? What are you seeing?
Okay, here's where I'm going to brag. Since 2014, we have done 20 offerings every single month on an average. 20 offerings every month. In October of 2022, we did 3. Okay? And we worked up to August, where we are 13. I'm feeling pretty good about myself. And in September, we did 2. So our business is down 50%. 50%. And I run in a circle of 5 or 6 relatively small companies like mine who are all fishing for the same business, and we're all down about 50%, and it's all because there's no deals. What we started talking about, sellers aren't interested in selling, and there's no friends who'll buy. But it's a normal market.
So other than that, are syndication sponsors facing any other challenges right now?
Well, the challenges are the interest rate cap. And capital calls. One of the things that's happened is that I get a lot of people calling me and saying, will you look at the operating agreement that someone else did for me? And I need to understand, what does it say about how I can raise money from investors in a capital call. So that document has to be drafted in anticipation of the fact that you might need a capital call. And as I said, my top 3 clients, no new deals this year, and they're all dealing with capital calls, and until they collect all the capital they need to save all their investments out there, there'll be no one putting new money in their deals.
So at the time of this recording, so heading towards the end of 2023, going into 2024, what are some things that should be on the mind of, let's just say, the real estate investors out there that are in multifamily? Multifamily,
okay. I think there's an imbalance of supply and demand in the country. I think there always has been. There's not enough supply to solve the demand of people. So I kind of like multifamily because of that. And another thing I like about multifamily, almost every one of us has lived in an apartment building. So we understand it. Not everyone has rented a space in a storage facility or worked in a retail center. But we've all lived in an apartment building, so we kind of understand that. And in my opinion, there's more buyers and more sellers and more tenants and more lenders who do multifamily than any other of the food groups in real estate. So I think that will always be a strong market, relatively speaking. There's someone here I talked to who's with Bank of America, and you mentioned you're not doing any office financing right now. So that's I think that's the back end of the food group today because of virtual. We had 7 people in our office in Marietta when COVID hit. And now we're all virtual. From Boston to Nashville to College Station, we're all San Francisco, we're all virtual. It's just really changed. I'll tell you one aside that your audience is going to love. A couple years ago in 2019, I took my daughter to China for 3 weeks on a great trip. And we single-handedly brought COVID back to California. We got off the plane, we were sick on the plane. I got home, I was sick, I went to the emergency room. The emergency room said I had influenza B. You ladies will love this. Take the Z-Pack, take NyQuil and DayQuil, and you can go home and you can tell your wife, you're highly contagious. And my daughter had it and I had it. I had it for like 5 months. It was just unbelievable, and no one knew what it was. So thank you very much, Gene.
Thank you for the flag on the YouTube channel, Gene. So you mentioned this a couple of times. You said that that this is a normal market. So speaking to, let's just say, that newer investor that'll watch this recording, and that maybe they bought their first home a couple of years ago, so they knew what that interest rate was like, and now they're thinking about, hey, getting into investment property or something else, the traditional story, and now they're looking at 6% or whatever the amount is for their interest rate, and they're thinking about getting in the market. What kind of things would you tell them from your experience?
Well, that most of the real wealth in this country has always come from real estate. So I wouldn't hesitate to look at real estate in today's market, not worry about what it was a couple of years ago. Look at today's market and people who are doing deals. I mean, you're in the last panel. They're high on real estate, all different types of real estate, but they're talking about the underwriting has to be good, the room for risk. I'm supposed to write really good documents and tell everyone about all the risks they can take. And in 2020 or 2018 and 2019, I didn't write in there the risk of a pandemic coming. And if you were going to invest in multifamily, you couldn't inspect all the units in your building. The state was going to come in and say your tenants don't have to pay you rent. I didn't know about that. And then the offerings we wrote in 2002, we didn't say, interest rates are going to go from 3 to 7 in about 6 months. So if you're getting a 5-year a bridge loan, be careful. We certainly had interest rate risks, but no one knew what it was. So you have to study. One of the things that you're supposed to be if you're going to invest in syndications is you're supposed to be a sophisticated investor. That's a technical term, but I think what it means is if you're going to invest in something, why don't you study about it before you do? Learn something about multifamily. Learn something about mobile home parks, because a lot of my sponsors have gone from multifamily to mobile home parks now, take their investors with them, and I wonder if their investors know anything about the mobile home park industry. I took a tour of a space of a company that builds coaches. That's a lot different construction than an apartment building is. And so I think there's a lot to learn, and I think as an investor you owe it yourself to increase your knowledge before you invest. You can't count on the sponsor to educate you. You can count on the sponsor to do a good job on their deal and manage your money when they have it. But overall education, I think you have to take some responsibility yourself. Don't you?
Oh, yeah. All right, so similar to the last panel, there's going to be time here for the audience to ask questions. I have one more question for Gene here. So Gene, you mentioned those 4 questions that people should be asking a syndicator, right? So one of our goals here at Mission Matters is to inspire others to start their own business, to become maybe a real estate syndicator, but to really follow their own passion and their own dream. So to the would-be syndicators out there that are thinking, hey, I've never raised money, like you said, somebody had to write that first check, you had to get started, right? The chicken or the egg scenario. What would you tell them?
Well, I've interviewed 37 of my clients for my YouTube channel, and I asked them 3 questions. How did you get in the business? What do you think is going to happen in the next 3 years? And what advice do you have for rookies? So right now I'll talk about 2 of those questions. How did you get in the business? All of us got in the business the same way. Hey, I found a piece of real estate that I didn't have enough money to buy myself, and I wanted that real estate, so I had to go out and find some investors. And I always say to people, if you have enough money to buy all the real estate you want yourself, don't do this. Don't be a syndicator. Why take on all that risk? Why go to court? Why do that? Just buy your own real estate. But that's how people get into business. So there you go. And then the best advice for rookies is, this is not a do-it-yourself, nothing down business. You should, and we already talked about continuity, you should find someone to do this with. There's someone out there who has a skill set that matches yours, and the most successful I've been in matching people would be a broker who knows how to go out and find a great deal, but doesn't probably know how to manage it. And then we'll find a crack property manager to team up with the broker. The property manager might not know what a good deal is, but he knows how to manage a deal. And now we've got a team. That's the type of team that I had. And I think that when you're looking for investors, I think you have to look for investors who are interested in real estate. Don't worry about someone who only invests in Bitcoin. You got to find investors who are interested in real estate. Number 2, you have to tell the investors why the certain type of real estate you are looking at has opportunities. What are you specializing in? What are the opportunities in building storage facilities? Okay? Do you know anything about that? Sell the sizzle of that opportunity, and then sell the sizzle of your team. Because you just can't do it yourself. You just have to have a team. And then if you find people who have the sizzle of real estate in their mind, your story of opportunities in their mind, and they love the sizzle of your team, when you show them a deal, it's half sold. They should be okay if they're sophisticated, and if they're knowledgeable.
Awesome. I feel like a lot of things you mentioned, that works for just business too. Like somebody bootstrapping or starting to be like, there's so many overlaps. I feel like that could have been, how do you start a media company?
Yeah, okay.
Sell the team.
Sell the team. I think that's very important.
All right, let's take some questions. Let's see, who do we have? Any questions for Gene?
Sure. You mentioned that this is a normal market based on your experience. Could you share more normal market facts? Not the past 3 years, but what are other dimensions of a normal market that we might want to, meditate on based on your long experience?
One of the things I think is a normal cap rate is built by looking at the risk-free yield, 10-year T-bills, and adding 3% for real estate risk. That's always been the case. Even when cap rates were selling, when properties were selling at 3 cap rates, is because there wasn't any interest being paid on interest-free T-bills. So you had 3 is a reasonable cap rate. Now we're at 4 plus 3, which takes you to 7. Okay, and so that's reasonable. And interest rates, relatively close to the cap rates, is normal. Not a big gap like we saw before. The only thing that I don't think is maybe as normal as I would like to see. There's just a lack of interest in doing transactions right now, and that's just because we just come out of whatever we just came out of. So that's what I think of a normal market, and certainly the number of transactions that we did from 18 to 2022 was much faster. The velocity was much faster than it normally is.
Anyone else?
So, does anyone ever read these syndication agreements, by the way? Besides the people who write them.
Yeah, when I do my educational event, I talk about mistakes that sponsors make. And one of the mistakes is not reading their own documents. And so if the engineer you want to invest with you reads your document and asks you a question, it would be really nice if you knew what the hell your document said. So I don't think that the investors read them as much as they should, but I'm very concerned that you read your documents. In my documents, it would be Articles 11 and 12 that deal with liquidity. There's voluntary liquidity, and then there's involuntary liquidity. And if I'm facing that investor who has those 4 questions, the last one is, what's my plan for continuity and liquidity? I need to answer. The most asked question I get about documents from my sponsors, which just bugs me like crazy, they're in the middle of fundraising, and they call me and say, Gene, I've got a guy who's got $500,000 sitting in an accommodator's account coming out of a property, and he wants to do an exchange. Can we have him invest in our deal? There are 3 places in bold in my documents that say this is personal property. It's not real estate. So it doesn't qualify for an exchange for the individual investor coming in. The LLC can exchange because it has a deed. So in my gracious approach to the investors, to the sponsor, I say, can you get document up on the computer? Let's go to page 4 and let's read this together. So I know at least one time they've read what I wrote.
And we have time for one more.
Can you talk a little bit more about your actual business? From the website, it looks like you guys sort of, do all the work to get someone ready to raise funds. But do you also have investors that you then take those deals to, or what exactly does the group do?
Our clients are the syndicators, the sponsors. We do the documents and hand the documents off to the syndicators, and then they go forth and raise their money.
All right, let's all thank Gene for being here. And Gene,
Thank you for having me. I appreciate it.